Pound 8, 9 billion. That's the staggering sum private equity firm EQT AB offered to acquire Intertek Group Plc, a global leader in product testing and certification. Yet, Intertek firmly rejected the bid, continuing a pattern of resistance against EQT's advances. This wasn't a minor negotiation. It was a high-stakes battle over valuation and strategic control. Intertek's decision to spurn such a significant offer reveals a deeper conviction about its intrinsic worth and future trajectory, a conviction that often defines the most resilient businesses. Intertek, founded in 1885, operates in the critical business of total quality assurance, testing, inspecting, and certifying products and systems across diverse industries. From ensuring the safety of your child's toys to verifying the performance of aircraft components, Intertek is the unseen guardian of global commerce. Their work is essential for regulatory compliance, consumer safety, and brand reputation. In an increasingly complex global supply chain, companies like Intertek provide the trust and verification that underpin billions of dollars in trade every single day. EQT's interest wasn't casual. This was their latest attempt, signaling a belief that Intertek's current market valuation does not fully capture its potential. Private equity firms often spot companies that are undervalued by public markets, seeing opportunities to streamline operations or unlock hidden assets. However, Intertek's board sees things differently. Rejecting Pound 8, 9 billion suggests they believe the company's long-term growth prospects, its strong market position, and its consistent revenue streams are worth far more than EQT's generous offer. Their confidence likely stems from several factors: the stability of the testing market, the increasing complexity of regulations driving demand for their services, and Intertek's own global network and brand equity. For Intertek, accepting the bid would mean ceding control and potentially altering its long-term strategy to satisfy private equity's typically shorter investment horizons. Their refusal indicates a preference for sustained, independent growth over a quick, albeit massive, payout. This isn't just about money. It's about strategic alignment. A company's board has a fiduciary duty to maximize shareholder value, but that doesn't always mean taking the highest immediate offer. Sometimes, protecting the company's future growth and market position is the more valuable play. So what does this mean for you? Here's what to do with this. First, understand your true value. Intertek wasn't just looking at its current market cap. They likely performed a discounted cash flow analysis, projecting future earnings and growth. Learn to calculate your business's intrinsic value beyond its immediate P/E ratio or market sentiment. Second, assess your strategic leverage. Intertek's global footprint and essential services give it strong bargaining power. What unique assets, market share, or recurring revenue streams does your business possess that make it indispensable or highly desirable? Third, don't be swayed solely by big numbers. Pound 8, 9 billion was substantial, but Intertek prioritized its long-term vision. Before accepting any major offer or making a significant pivot, ensure it aligns with your core mission and long-term growth strategy, not just a short-term cash injection. The strongest takeaway is this: always know your worth. Intertek knew its business was worth more than EQT's offer, and that conviction allowed them to walk away from billions.